Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We help hedge funds, family offices, RIAs, and individuals get better returns in the stock market. This is our special subscribers only webinar to talk about the markets, to talk about investing, some specific stocks. I am joined by two fantastic guests. Chris Bell is the National Sales Manager for Horizon Kinetics. He's also a member of the Deep Knowledge Investing Board of Advisors. We're also joined by James Davolos, who has been a DKI guest, I think 3 or 4 times now. The first time James was on was a year and a half ago. He made some very specific predictions about the economy, about housing, proved to be right about just about everything. He's also the portfolio manager for the Horizon Kinetics Inflation Beneficiaries Fund. Star portfolio manager. His performance last year was fantastic. I mean, beyond top quartile, he was top performer. And as a result, his opinions have become highly sought after. James, it's pretty amazing how great performance will make people want to talk to you.
Quite the introduction. Thank you very much, Gary. Happy to be here.
Yeah, thank you. And Chris, thanks for getting James on here with us. Ramiro, thanks for tuning in. I'm going to ask you to turn off your video there. We're just going to keep this to the panel. Thank you. I appreciate it. All right. So my view is since November, we've had very inconsistent economic data, right? We see, manufacturing down, consumer spending is up, goods are down, except for last month. Services is up, unemployment is down, wages are up, but people are still falling behind inflation. Real wages in general have been dropping. That's based on a CPI calculation, which we've all talked about is not necessarily accurate. So I've been watching the last, 8-9 months and seeing very inconsistent data. What are your thoughts on this? What are you seeing big picture?
Yeah, I couldn't agree more. I'd say if you are running a macro fund or investing purely based off of macroeconomics, this is the most confusing market and the most contradictory market that I think anybody might have seen in their entire career. And what really befuddles me is how people can have such extremely high conviction, particularly on short-term narratives, given this extreme level of uncertainty. So I'm going to punt the short and intermediate term view because I think there's just no way to really have that much edge. But I think there's two concepts which really stuck with me. One from undergrad when I was a horrible student in philosophy, learned about the concept of Occam's razor, which simplest explanation probably is the explanation. Number two, when I was in graduate school, one of the quotes that stuck with me most reading volumes of Warren Buffett was, follow people's incentives and I'll show you the outcome. So let's take both of those two subjects today when we look at the global economy and all of the conflicting signals. One, incentives, and Occam's razor. The dominant force in the economy today is not interest rates. Again, everybody listen to Jerome Powell, follow Fed minutes, follow Fed fund futures, have a blast. They don't really matter that much when we are running a $2 trillion deficit. Our mutual friend Lynn Alden has gone into great detail on this, where fiscal is dominating monetary and everybody is still trying to read the tea leaves through monetary. But again, what's the simplest explanation? Politicians like to stay in office and politicians are going to continue spending money. There's really no credible pathway to getting us into a balanced budget or surplus. So let's view that as a constant. If that is a constant, there's going to be higher and volatile inflation, and that's going to mean there's going to be higher and volatile interest rates. And I think that really explains how to be positioned when you're willing to look out past the noise of liquidity driving markets year to date.
So let me, those are great points, James. Let me unpack some of that for the people who are going to end up listening on YouTube or on the website and, may not be able to follow all of that. One key thing is when James is talking about an inability to predict, we saw at the beginning of the year something that I thought was hilarious. The sell side was actually at some point predicting lower earnings, but no recession. They were predicting recession. but increases in the stock market, right? I mean, basically none of these people are talking to each other. None of it was designed to make people money. It was just marketing nonsense. When James is talking about Lynn Alden's view, he's referring to her last monthly letter, which I recommend reading. It is absolutely fantastic. And she made a key point, which is if you go back to the last inflation crisis the United States had, this is the late 70s, or actually throughout all of the 70s, but it lasted into the early 80s. A lot of that was caused by changes in commodity prices, the US coming off the gold standard, and the Fed having not really having the Arthur Burns Fed not having the courage to keep higher rates for longer, which is what they should have done. And so a lot of what happened was caused by the Fed, and so the Fed solution fixed it. What Lynn pointed out, and I agree with this, is much of the inflation issue that we're having right now is related to massive amounts of government currency printing because we're overspending. Right now, the on-balance sheet spending is about $2 trillion above tax receipts every year. So that's an extra $4 trillion by the next presidential election that the US will be taking on in debt. And because those problems are not created by the Fed, and the only instrument the Fed really has to try to affect policy is interest rates, that's one of the reasons why they're having so much difficulty getting inflation down, because they're trying to solve a problem created by Congress with the tools that they have at the Fed. And there's a mismatch between the tools they have and where the actual problem is coming. Either James or Chris, do you guys have thoughts on that? Do you have a different view, or do you think that's what that's the argument being made?
No, I think that's basically it in a nutshell. We talk about the capital cycle. So if you're not investing in these critical raw materials that are needed for this transition, Volcker got a lot of help from fiscal, from emerging market commodities, from emerging market labor. There were a lot of things that helped Volcker get price levels down that Powell does not have. You also have you can't even quantify how much more leverage is in the system. So the vulnerabilities, if there is a crack in credit, I think one other thing that really reinforces the point is that if we've seen twice now in the developed world post pandemic response, cracks in credit. First in the US with Silicon Valley Bank, what did they do? They flooded the system with liquidity because they are not willing to let credit go. Then, or subsequently in the United Kingdom with the gilts, what did they do? They flooded the market with liquidity to stabilize it.
Right.
You also saw pre-pandemic with the reverse repo market freezing. So if you look at Zoltan Posnar, I'm sure people are familiar with him and his work. He was at Credit Suisse. Before that, he worked under Paulson at the New York Fed. He actually drafted a lot of the TARP policies during the global financial crisis. He said, look, they don't care if ARC goes to zero. They don't care if Microsoft goes down 80%. The second there's a crack in credit, and a crack means no bids. It's illiquidity, not necessarily just a spiral in price. They pile liquidity at the problem. So the ability to let kind of like a healthy fire basically burn out the scrub is really not there either. So again, every path, you don't know the pathway, but everything leads back to this debasement inflationary world.
Yeah, that's entirely right. And one of the things, obviously, the entire government right now, not just in the US, but really all over the world, they're being run by Keynesians and people who were trained Keynesians. And his theories should have been much more widely discredited by now. But the issue is the Keynesian theory is you spend less in good times, and then you use government spending to goose the economy in bad times. And the idea is by having some sort of smart government interference in the economy and direction of the economy, you can sort of keep things on even keel. And the issue is we are now in hyper spending everywhere, right, all the time.
One other thing, Gary, I'd like to mention, and, we go back to everyone's hero, Volcker. The things that benefited Volcker, what James was talking about, are in exactly the reverse now. So the move to globalization of the labor force, the move to some of the countries that had never sold hard commodities to the marketplace to lower commodity prices, that's gone in exactly reverse. So the benefits that Volcker had are now detractors to any success that the Federal Reserve is going to have.
Right. The whole globalization thing has gone
Run
in
in
reverse.
reverse.
Right.
Yeah.
We're going from a period where we had expensive onshore production being offshored cheaply, and now everybody's saying, wait a minute, our supply lines are no longer secure. We need to pay up and do this here. And that's actually not bad analysis, right? I mean, think about it in terms of computer chips and pharmaceuticals. We're getting all of that stuff from China and Taiwan, not necessarily in that order. Does anyone want to count on China for military grade computer chips or AI grade computer chips and our pharmaceuticals? Those are huge problems. Great comment from David in the comments saying you can only kick the can down the road so many times. And he's right. The amazing thing about this is we've had about 40 years of this kind of crazy spending, right? President Reagan, for in general, great stewardship of the economy, was a big spender. Clinton was a big spender. President Bush was an even bigger spender. President Obama took the Bush 2008 TARP bailout, the extra $1 trillion, took that as a baseline and started to spend more. President Trump then did the exact same thing. He took that as the baseline and then spent more. And now, this current administration has gone completely crazy, throwing trillions and trillions of dollars that they're calling infrastructure, but it's not. It's social welfare spending. And we can argue that that's a good idea or a bad idea, but it is certainly going to create inflation and debase the dollar. James, I know you had a bunch of really good slides here. Anything you want to go through while we're on this?
Sure. I mean, I think we can kind of just run through the slides quickly, just about the market setup, and I'll leave people to draw their own conclusions. But if you go to slide 2, this I think shows you that we're in completely unprecedented times. So the blue line is the S&P 500 earnings yield. As you mentioned, a 4% earnings yield is about a 20 multiple. So that is pretty expensive. If you go back to 2000, we're bumping up, minus the lows in 2009, minus the pandemic lows. You're almost kind of at the lowest level you've ever been at. But more importantly, you've had the Fed funds cross through the earnings yield on the S&P. That hasn't happened in 20 years. So this regime of 20 years of 60-40, giving you a 10, 12% return with no vol, and equities just going up every year with no vol, is over. Biggest difference, though, in 2001, the Fed was easing. We went from 7 down to 1. Now we've gone from 0 up to 5. So really different framework to think about. In terms of kind of correlations on slide 3, which kind of dovetails on this, this shows you the NASDAQ in the blue. So post global financial crisis, you had this really bizarre positive correlation between stocks and bonds. Typically, that should not be the relationship, because higher yields are gravity to bonds or to equity prices. In this case, you saw that relationship starting to break as the Fed started to normalize policy in 19. You can see the kind of blue and gray lines diverge. Then you saw them correlate again, where you went to 0 on rates and you saw the NASDAQ just fly higher. But then you saw that relationship kind of converge again, where they started to hike in late 21. The NASDAQ peaked and they went into that traditional relationship again. But that broke again, where then you can see the 2-year yield absolutely collapsed because everybody thought rates were going to go down when Silicon Valley Bank went down.
Right.
Clearly something else is going on here, because duration in the NASDAQ has absolutely gone on a tear. It started the year strong, but it's gone on an absolute tear since Silicon Valley Bank, even though real yields have gone up and even though terminal expectations have gone up. So slide 4 actually shows this. Sorry, this shows the equity to commodity ratio. If you, we can come back to that later, but if you go to slide 5, this shows you, okay, so the treasury yield has inverted. So we're at the steepest inversion of all time. So again, you have 7 tech stocks rallying because they think rates are going to go down, even though this is the steepest inversion that we've ever seen on record.
Right.
But then slide 6 shows you how policy's actually gotten tighter. So the current policy, the blue is the current dots. So if you were to take gray, which is the beginning of the year, and slide it back one line, because basically this is half a year out as of the end of the year. So basically the gray line was saying that right now, we would be much lower than we are. And it was also saying where between 0.5 and 1, we were basically going to be cutting down to 4.5. So cuts by the end of the year. Now you're basically saying by the end of this year, we're still going to be close to 5.5. So that rate hike that rate cut that everybody was expecting, at least Eurodollar futures are saying that's been pushed out. All else equal, that would not be bullish for risk assets that have long duration. Similarly, on slide 7, you can see again, this is the Atlanta Fed SOFR path. So this uses a pretty complex model of Eurodollar, LIBOR, and Treasury futures. The market is basing off 400 basis points of rate cuts. So that's saying between now and the end of next year, we're going to cut 400 basis points. And I think that that is really what's driving the market is all, I use this term, I use it however it is. Monkeys that are buying stocks without doing any fundamental work are just saying, okay, rates are lower. We're back to the 2019 gambling era, just buy everything. And I think that's the mentality, certainly post Silicon Valley Bank. But again, going back to my earlier comment, like what is going on here? If you go to slide 8, I'm sorry, I'm trying to go through these quickly so we have time to discuss things. But
yeah,
historically, the blue line, so that's Fed balance sheet assets. That's what most people say, okay, that's liquidity. When you throw liquidity into the system, things go up. So you see 2010 through 2014, pretty much we were straight up with liquidity. We kind of flatlined a little bit, and then we really saw some problems hit in 17, 18, the end of 19, when you saw some real contraction in the Fed's balance sheet. You can see the S&P had that big taper tantrum. Started growing it, the balance sheet again, obviously massively in COVID, and the market flies to new all-time highs. Again, you can see the Fed balance sheet contract. I mean, the spike there is Silicon Valley Bank, but you're still having a rally in tech. So maybe the next slide can give a little bit of light into that, and goes back to my comments on the gilt crisis in Silicon Valley Bank. We lift the debt ceiling. The axes here are a little bit misleading in the gray. That's $1 trillion of debt that's been added. That went into the economy, minus the Treasury General account, where we kind of bled the TGA from 600 billion to almost zero by the debt ceiling. Mm-hmm. So some of that trillion has gone back, about half of it into the Treasury General account. But my point is they're adding liquidity when these things do happen. And I think it's pretty obvious where it's going. The next slide can show you, I think, with pretty strong evidence where it's going on slide 10.
And by the way, James, try to imagine, and not that I have a lot of sympathy for Jerome Powell. Deep Knowledge Investing has been incredibly critical of Powell and the Fed. We're on team and the Fed. But try to put yourself for a minute in Powell's shoes. Imagine doing everything you've done over the last year and a half to try to get inflation under control, and the Treasury has just poured $500 billion of liquidity into the market. I mean, it's
yeah.
At some level, you have to figure there's going to be a cage match between him and Janet Yellen.
I think it was Louis Gave from Gavekal had a really interesting point where he was like, he noticed when COVID hit, Powell was yelling from the rafters saying, I need fiscal help here to actually stabilize things and prevent deflation. This time around, when the Fed keeps spending, or excuse me, the government keeps spending, and he was asked about fiscal, he simply just said, like, are you communicating with Yellen? Are you communicating with Congress? All he said was no. So clearly, he's just not touching the issue. They have to be communicating. But to your point, Gary, like, yeah, it must be really frustrating. But, the politicians are going to stay in office, and to do that, they're going to spend money. But go back to that 500 billion of money just flowing back into the market of liquidity. So you can see kind of over the past couple of years, that this account has basically been shadow measures of liquidity. But on to slide 10, I was saying, where do you think this is going? So maybe early on in the pandemic, you can see that fund flows going up to the pandemic were, neutral for basically everything. Tech in the dark blue, materials pretty flat and gray, even energy pretty flat and light blue. Immediately after the pandemic, you just see skyrocket in tech fund flows, that blue line. So yes, there's a bigger market cap there. So sure, you need to look at it relative to a percentage of investable assets. But you saw in the last 5 years, you've seen 90 billion go into the top tech ETFs, 22 billion at the peak for energy, 10 billion for materials. The really telling point, though, is in the last year, energy topped out early 22 at 22 billion. It's given back half of those assets. That is really, really significant in explaining why energy's been weak, because of all those outflows. You've seen 10 billion go into materials. They've given back 40%. You're back down to 6. Tech, okay, you've got 90 in. You're basically still at an all-time high. You've given back, 5 billion.
Right.
So the money is clearly finding its way into tech. And I was talking to a pretty sophisticated advisor yesterday, and he said, the big problem here is that unsophisticated money, they bought tech, they didn't care. It can't go down. They get walloped last year. The worst possible thing happened. It went right back up. Now they're like, oh, it's bulletproof. Now I'm going all in. I don't care if it goes down. It'll just come right back. That psychology is so dangerous. It's almost like 99-esque. But Chris's point earlier, if you go to slide 11 about the top 10. So what are you betting on to basically buy these stocks? So on the right-hand side, you see the long-term earnings growth rate of Bloomberg consensus bottom-up estimates. So Apple, by the way, a company that's not growing revenue, you're betting on 13% compound annual growth in earnings for 5 years. Microsoft 15, Amazon 60, NVIDIA 40. The list goes on. So Peter brought up a really good point. So Apple, 3 trillion, Microsoft, 2 trillion. I'm using round numbers of market cap. Ultimately, let's assume everyone's buying stocks because they want to earn an equity-esque rate of return. If risk-free rate is 5, let's say 10. I think 10 is a reasonable return for taking equity risk involved. Some people might say that's crazy. I think that's a pretty reasonable number. Ultimately, you will need to grow into a 10% cash flow yield to justify 5 trillion of market cap between Apple and Microsoft. That means in order to do that, you need $500 billion of annual net income to justify those stocks if you are saying I'm betting on a 10% long-term rate of return. To do that in real terms, I would say is almost impossible based on just a law of large numbers. You're talking market cap equivalent to 15, 20% of our entire GDP. Right. And for that to grow at a 15% compound annual growth rate to then get you to that 10% yield, just law of large numbers, the math there just doesn't work. By the way, you're betting on 25% CAGR for the top 10. You're betting on 10 for the rest of the S&P, which, by the way, is pretty heroic based on where we are today. Go to the left-hand side in energy, you're underwriting 2% annual declines. I think I know where I'd rather kind of have my money on a risk-adjusted basis. Last slide, slide 12, just quickly kind of on the fundamentals of what we do. A huge part of what Horizon does, huge part of INFL is royalties. So this goes back to 1993, so 30-year chart of the gray line is West Texas Intermediate crude. So over 30 years, you've only made 4 times your money. You annualize that, you're doing terrific, certainly in real terms and nominal terms. The S&P, you've actually done decent. That green line, you've done about 17 times your money. ExxonMobil, the largest and kind of best operated oil company, right around there. So you've basically been step in step with the energy, with the S&P, notwithstanding the recent underperformance of energy and outperformance of tech in the S&P. Those two blue lines are two passively managed royalties and energy. You've done 70 times and 73 times your money. So a factor of almost 5x Exxon and 5x the market. So this shows you the royalty business model, stock picking. You've actually trounced the beta of the market. You've trounced the beta of energy, and you've trounced the beta of oil, owning the right business models at the right price. And these are passive. All they do is just give you back your money every quarter. They're not trying to reinvest and enrich themselves and do all of these kind of external operations. And so again, whatever your views are, I think that our point in what we do at Horizon is we try to find an efficient, eloquent way to express that view on a risk-adjusted basis. And here, I think royalties really show you that this is a great way to do it.
Amazing, James. Let me go back, and I want to comment on a couple of things you were talking about. When we go to this slide, here it is. One of the things that jumps out at me is this slide shows the shifting of the good news is bad news narrative, right?
Yep.
So early on, what you see is good news for the economy is good news for the stock market. Then we hit this period where good news for the economy made everybody think, oh no, Powell's going to raise rates more. That's bad for the market. So good economic news sent the market down. And then recently, we saw a shift to good news is good news again, right? Positive news on the economy made the stock market go up. And now we're really in a situation where the market response is any news is good news, right? Good news for the economy makes stocks go up because earnings will be better. Bad news for the economy makes stocks go up because the Fed is going to pivot. And that's a dangerous place to be. And that's one of the ways you get to a 4% earning yield on the S&P 500 when you have better than 5% in government bonds, right? Your safe haven is yielding more than your risky pick. The other thing I wanted to point out, let's look at this slide for a minute, because you were talking about hundreds of basis points of expected cuts. And there was another slide where you were talking about, I think, 400 basis points of expected cuts. And the thing that's incredible about that is people think that with $32 trillion now of government debt going to 35 trillion in the next 2 years, that we're going to get back to 0% rates. And people have no memory. There's sort of this sense now that, well, 0% rates are what we have. That's normal. No, we just had a really strange decade and a half.
And Gary, one thing I think that's important too is talking about rates in general. 53% of all Treasury debt comes due over the next 3 years. So currently, if you go to usdebtclock.org, you can see that the current interest expense is about $600 billion. That interest expense is going to double over the next year or two, to a point where it's way it's way above the current budget for the military. You're approaching entitlement budgets. It's going to take over all the characteristics of the U.S. budget.
So, Chris, when that happens, what are we going to do to pay the interest expense? We know the answer: print more money. And guess what, everyone? That's the definition of a Ponzi scheme.
And that takes you to hard assets and scarce assets, and it takes you to Bitcoin, and it takes you to gold and petroleum and other things like that that are valued in dollars.
Yeah. And by the way, for everyone listening to this, Chris's comments are important. And that's why we've been watching Japan so closely. Japan is years ahead of the United States in terms of this debt and interest expense problem, in terms of a weakening economy. So Deep Knowledge Investing, we've been watching Japan very closely. Really, they're sorry to use an old expression, the canary in the coal mine, because when you see Japan have this Ponzi scheme death spiral problem where they need to raise rates, and that'll blow out their government budget. And once that happens, they have to print more currency, weakening the yen, causing more inflation. This is why it's called a spiral. That's the model for what Western Europe and then the UK and then eventually the US will be facing, right? I mean, the thing that we've been saying all along is Argentina is trying to become Venezuela and the United States is trying to become Japan. And none of that goes anywhere good for any of us. So Chris's comments on gold, on Bitcoin, on energy, these are all things that we own in size. At DKI, we are not long a whole lot of US dollars right now. We bought alternatives for pretty much everything. James, what sectors do you like right now? And I know you can't talk about specific stocks. We're not going to do that. Let's just talk general, like where are good places to look.
So to your point, this isn't really a sector, but I'll get to sectors in a minute, but I think this is important. So I agree wholeheartedly with your dollar view. Couple that with our view on raw materials, emerging market value. I know it's been this brutal trade that smart people have been calling for years and years. I mean, GMO research has been basically saying like this is the pocket of huge opportunity in the world, and frankly, they've been wrong for a really long period of time. But EM value, it's really not China exposed, but you've got exposure to that negative dollar exposure, commodity exposure, and some of these markets that I think are going to decouple because they don't have the debt burdens that we have. If they don't have to transact in dollars, they don't have the dollar dynamics that you've talked about. So I think EM value is, from a top-down standpoint, getting pretty interesting. Sectors in the US, I mean, obviously, we're big believers in energy and materials. I think industrials are getting really interesting on a price basis, and they've been pricing in this horrible recession in fundamental terms, whereas tech is pricing in lower rates and no recession. I could see a renaissance of US manufacturing, of US industrials. Certain industrials have also de-risked and become less cyclical. So think like US rails. Trucking has a very idiosyncratic issue going on that's very different from the rails. So I think those are great places to start. Maybe you could start to nibble in healthcare, just kind of where some of the bottom end there has gotten really cheap, just so washed out. But I'd say that's kind of a, far less compelling than the other areas to look at.
Yeah, I'm with you on healthcare. We actually just rebought HCA. It was a hugely profitable position for us a couple of years ago. The stock was more than double in, I think, 12 months, something like that. And we've gotten back involved because there's this really interesting situation. We had thought that all of the COVID-related catch-ups, people who needed knee surgeries or, other kinds of important but non-emergency surgeries, we thought that had made its way through the system through like 2022. And it turns out that there's still a huge amount of high revenue catch-up work. The other thing is there was all of this talk about how, and I spoke to the heads of half a dozen hospitals. I spoke to people running HR, entire departments, and everybody was telling this story about higher expenses, how hard it is to hire people, how expensive it is to get nurses. But when we look at their actual margins, guess what? The actual numbers don't match the narrative. And everybody's saying it's too expensive. We can't make money like this. We need more reimbursement, or we're going to go out of business, or, the small hospitals will go out of business. We'll survive, but barely. But when you look at the actual numbers, their expenses are not only in line, they're below historical numbers.
Yeah, I mean, the other really interesting about healthcare, and like HCA in particular, is if you are worried about the economy, those are not discretionary items. These are things where you want a recurring revenue, stable business where okay, people bought their flat screen TVs, they remodeled their house, they put in their pool, they bought the new car. That stuff, yeah, those are the cyclical inflation drivers that I don't want exposure to. But when you talk about resiliency in earnings, I think that's the thing that is pretty attractive about healthcare. And the other thing is within healthcare, you've seen this really negative capital cycle where it got really hot when everything that was theoretically a pandemic beneficiary ran. You look at the amount of biotech nets that are out there today, the capital cycle has actually gone in your favor in healthcare. But I wouldn't necessarily say buy everything, but to your point, there's diamonds in the rough there if you're willing to do the work in healthcare for sure.
I think it's also important to note sectors that you should not move into. And I think the big real telltale one there is commercial real estate. And James has done a ton of work on this. James, you want to talk about that?
I mean, just basic math. If you did a multifamily project, and this is a lot of private and shadow credit, it's more pronounced than in public markets, but there were people buying multifamily deals at 3 and 4 caps, particularly in Florida and the Sun Belt. So that means that your operating cash flow yield, so before any maintenance capex, before any opex, before anything else, it's really the crudest measure is a 4% yield. So you're borrowing at SOFR, which was effectively 0 plus 200 or 300. Okay, you have a razor thin margin, but you're like, all right, if I can raise rents a little bit, then I will get a better cap rate on that higher rent yield. Then I will take out more debt, typically 80%. Great. I just created a ton of equity for myself, taking risks with other people's money. Now they got greedy and they said, I'm not going to rate lock. So, SOFR 2 years later is now at 5. 5 plus 3 is 8. You have 8% paper on 80% of your cap structure when your asset's yielding 4. You're insolvent. And we have an internal person at Horizon who does bridge lending. And he said, I used to be the guy that everyone was embarrassed to talk to at multifamily conferences in Florida. The guy was just down in Miami, and people were like fighting each other to get to me and say, look, bridge me a year, bridge me a year. Why bridge me a year? Because the Fed's going to cut in a year and they're going to bail me out. Obviously, great. They're going to cut 400 basis points to put your property at break even. Like, anyway, I think there's a lot of dynamics out there where you have negative cash on cash yields in the real estate sector. And maybe it hasn't flowed through. I think obviously you have multifamily assets in the public market that are really well capitalized, but who was it? There was Ashford Property Trust just gave back the keys to a bunch of hotels. Brookfield's been giving back keys to a lot of offices. But then where I'm really concerned is that shadow financing. So everybody's a genius that can lend at 12% and mark no volatility because it's not publicly traded, just like private equity. What happens when an LBO or a property is levered up 8 times and that 8 times leverage has a coupon of 12? That means over 100% of basically 100% of your cash flow is servicing your debt. That does not last very long before that project is a zero. So I think in a lot of these private credit vehicles, you're going to start to see cracks there. And who knows, is that going to be what gets Powell to panic and pivot or start doing some other type of stimulus? But this is a mistake that we missed. And, it's good to know your errors. We thought this was going to crack a lot earlier, but these people didn't reset overnight. And they didn't start basically cash flowing a full year of pain overnight. It takes time for this to flow through the system. And, people are poo-pooing the narrative that, okay, it takes a while to flow through the system, but, a year of cash flow, you don't start actually paying that burden until your floater resets. And then, every day is another day of pain. But if you do that full cash flow math on a year, it takes a year for that to fully kind of bake in. So I think that there's something coming down the pike in private credit and certain aspects of real estate. maybe even private equity, but I feel like private equity's got the liquidity and the lobbyists to kind of keep kicking the can.
All right, James, those are great points. Let me just clarify something you're saying for some of the people who don't do this all the time. What James is talking about is a situation where you have leveraged property and interest rates go up. And once you reset at the new interest rates, you no longer have an economical business, right? But not everybody has an adjustable mortgage on their property, or if they do, it doesn't necessarily adjust right away. So it's the same kind of thing where if you're listening to this, you have a mortgage on your home, and maybe it's a fixed mortgage or it's adjustable, it'll adjust in a year. Interest rates could rise to a level where you can no longer afford to stay in that home, except your mortgage may not adjust this year. It may not adjust at all. And so these things affect people at the margin, or when they refinance, or when their rates reset. And so you can have basically, it's almost like zombie businesses, right? They're dead. They just haven't gone out of business yet, right? They haven't run out of money yet, and their cash flow isn't bad yet, but it's going to be because there's no escape. They need to refinance at some point. The other thing that James is talking about that I think is a really important point is he's talking about the necessity for some of these businesses for the Fed to bail them out. And it's something on the equity side we've been talking about for a year or two. And in the FinTwit community, you regularly see people who are asset managers, although we refer to them as asset gatherers, saying, oh, Powell's ruining the economy. The Fed is ruining the economy. They have to lower rates. No, that's not it at all. What's happening is the Fed lowering rates would raise asset prices, which is good for their business. And they're basically asset gatherers. And our point all along has been, if you need the Fed to lower rates so that you can have good returns and grow your assets under management, you don't have a business. You've provided no skill, right? You're just riding the Fed and waiting for the government to bail you out. And James is correctly pointing out that same dynamic exists in commercial real estate as well. Some of these people have zombie businesses, and they're waiting, fingers crossed, that you'll have a situation where, the Fed will pivot, lower rates by a couple few hundred basis points, and somehow bail out the business. And if that's what you're counting on, you do not have a high quality business, and it's not going to trade at a high multiple.
You've also got zombie companies beyond real estate, companies that issued a lot of debt in 2000, 2001, 2002, when rates were near zero. And you're talking about companies that might have debt to equity ratios above 100, that are going to have to refinance their 5-year paper or their 3.5, 4-year paper. And they're going to have to refinance it, instead of at 3, they're going to have to refinance it at 8 or whatever. Right. And, they're not going to be solving either.
Yeah. So I want to ask James and Chris a specific question about energy investing. Guys, while I'm doing that, if any of you have questions, and I've already gotten some questions sent to me by email before this, just use the chat function. If there's anything you want any of us to address, just put it in the chat. Happy to have your questions. So James and Chris, again, I know you guys cannot talk about specific stocks, so I'm just simply going to say I know Horizon Kinetics has a substantial exposure to oil-related energy. We'll just leave it at that. For anyone else who's curious, you can look it up. It'll be obvious. I'm wondering, given that you guys are so positive on energy, and we are as well, I agree with you. And, we own the unnamed stock as well. It's on for subscribers listening to this, it's on the DKI recommended list. If you can't find it, send me an email, and I'll make sure you know what we're talking about. But what are your thoughts on pipelines, oil and gas pipelines, which is basically the railroads of energy, and uranium?
James, you want to go there?
Sorry, I was on mute. Yeah. So, I like the concept of pipelines. Just a bit of background. They raised a extraordinary amount of money years ago purporting these unrealistic growth rates. So it was this financial engineering. There was a general partner. You typically own the pipe in a limited partner. They got fees on your limited partner revenue that made hedge funds and private equity firms look generous and charitable. And they were incentivized to grow at all costs. But there's a finite amount of molecules to move, and you can't move molecules to the moon. So eventually they all collapsed onto each other. And so that growth narrative where they were trading at 30 times cash flow, now they're down at, in some cases 8 to 10, sometimes even less. That makes sense if you want to clip a coupon. There's not a lot of optionality left in pipes, at least to the extent that I can see. But if you want to kind of de-risk and just be okay, what's my yield? What's the pathway to growing that yield? And just being okay with a, fairly modest yield-based return, I think that that's great. So, for people looking for income, I think pipelines make a lot of sense. I think it's a little bit different if you're looking for long-term tax-efficient capital appreciation. I love uranium personally. I own physical through the Sprott vehicle personally. We own the largest liquid miners at Horizon. And the reason is that you don't need to underwrite growth and demand. So most of these markets, you need to underwrite at least stable, if not rising demand, because there is incremental supply, whether you're talking traditional energy, copper, gold, ags, what have you. In uranium, the market is so structurally undersupplied. All you need to basically underwrite is that plants are not going to be continued to get shut down aggressively. And if you look at the world's energy mix and understand the issues with intermittency, meaning if the wind doesn't blow and the sun doesn't shine and you don't have grid scale battery technology, which we don't, you need reliable baseload energy. Germany's burning more coal right now because they basically mortgaged their economy to renewables because they wanted to get rid of nukes, and it doesn't work. So now you're on coal.
And
my
wood.
Point is that what's that?
And
wood,
wood,
yes.
Right. They've shifted to 5,000-year-old technology.
Wood, by the way, is 10 times worse than coal if you want to look at it from a carbon emission standpoint. The energy density and the carbon emissions of burning wood is just comically horrible. But again, if you just assume a lot of this political rhetoric of shutting down nukes is not going to come to fruition, the upside leverage in uranium is gigantic. Specifically, if you get into a supply crunch where, a utility in Japan is like, oh my God, I can't get physical delivery this quarter. That uranium is a nothing rounding error in their overall operating expense of that nuclear plant.
Right.
They could bid up uranium 5 times and it doesn't even, you barely notice it in their financials. So yeah, would the market correct in time? Sure, but you've only got Canada and Kazakhstan. I mean, for those who don't know, look at where Kazakhstan is on a map and tell me if you want to rely on them. Australia's only got a tiny bit. So again, the ways to make a tremendous amount of money in uranium are plentiful. The ways to lose money would basically be a extremely rapid, continued closure of developed market nuclear generation capacity, which, maybe you think, okay, that is going to happen, but then tell me where the other energy is going to come from.
Plus with new technology, you've been able to, you're bringing back the old modular reactors where and now you're coating a lot of small pellets of uranium with a material that will sort of individualize the radiation. So you've now enabled these smaller modular reactors that are sort of going through the testing phase now. And a very interesting company down in Virginia has gotten a $50 billion contract from the US military to pursue modular reactors that would literally fit on a tractor trailer bed. And that could really goose the demand overall for uranium. If you think about not in my backyard, which is probably NIMBY is probably the biggest reason there aren't more reactors globally now because of the safety. And so you could put a small reactor which would a 3 or 4 gigawatt reactor in an unpopulated area, and you'd be able to service 100,000 households. So it definitely makes sense. Regarding pipelines, the one thing that James and Murray have talked about a lot with pipelines is make sure the CapEx is going in. Like you just have to make sure that, the pipelines are putting the proper amount of CapEx in. About 10 years ago, there was a real issue there where people were getting higher stock prices based on cash flows, and the flows were being managed by not putting the CapEx that was necessary to maintain the structure of the actual pipelines.
So great point, Chris. The other thing that you guys have talked about that I think is really important when it comes to uranium and nuclear power, a lot of people, all they can think about is 3 Mile Island, Chernobyl. And what they don't realize is the new Gen 4 plants are completely different. They don't melt down the same way. The safety profile is completely different. So we're positive on it. Again, for DKI subscribers who want to know how to play that, check the current recommendations page on the website. We have a ticker on there for uranium exposure. Again, if you have difficulty finding it, just send me an email and I will make sure you know what we're doing in that space. We've gotten a few questions. Let me just zip through a couple of the questions that people have. We got a question via email regarding digital education, online education, Coursera. Coursera has faced 3 issues. One is it was a high multiple tech stock. As interest rates went up, the entire sector got sold off. The second issue they had is they've been in a bad neighborhood. 2U has engaged in some horrendous business practices, and every couple of months, the Wall Street Journal puts out a hit piece on 2U. And when I've looked into the Wall Street Journal's claims, they're not actually hit pieces. They're accurate. We are not touching 2U because we think they have a bad business model. And then the other issue is Chegg, which is a cheating site. It is not the same business model as Coursera. And every time they announce earnings and take down guidance and say their business stinks, Coursera comes down with it. The final thing is, a couple quarters ago, the company gave horrible guidance. They lowered their growth rate on everything, expected growth rate on everything. I called the company and I asked them, I said, guys, what's going on? Like is your growth rate really falling from 25% to 10%, 15%? This is a huge change. And the response that I got was, oh, we're just being conservative. And then we got to first quarter earnings and they had huge growth, way above the crappy guidance they'd given. And then they continued to give bad guidance for the rest of the year. And everybody said, hey, what's going on? Why this huge decrease in expectations? And the response was, we're just being conservative. Basically, what we're seeing out of Coursera is continued growth. They add about 5 or 6 million new registered learners. Their platform is double the size of the nearest competitor. And in the tech space, having the largest platform, the largest exposure is generally the winning strategy. So that's what we're seeing there. We're seeing a lot of things affecting the company that don't relate to company performance. And I understand why management doesn't want to give very strong guidance that they'll miss, but they've been a little weak in their prior guidance. I think that's what's going on there. We also just got a question in the chat from David. Good question. Reading it out, given that the U.S. has this huge debt, right? 32 trillion now, almost $250 billion if you include the off-balance sheet, and that the country is dedicated to printer goes burr, right? We're printing way too much. When does this end, and how can one protect oneself when the end hits? So it ends when the dollar collapses, when we all go out of business. I hate to say it. I've been very fortunate to grow up in the United States. I always want what's best for the country, but all empires fall, and they all fall the same way with war, debt, debasement of the currency. That seems to be the plan that we're following. The question is, how can you protect yourself from that? And I'm definitely going to let Chris and James weigh in on this, but here's what I would suggest. Gold, maybe a little bit of silver, a lot of Bitcoin, energy, which is something we've been talking about here. Shorting the market is potentially an option. And Chris and James can't say it, but I do own a little bit of INFL, which is a fund that James runs designed to benefit from higher inflation, which is where you go up. Now, I know Chris and James can't comment on that, but now you guys know my opinion on INFL is the ticker, which these guys won't say, but I said it. Chris, James, what am I missing? What do you do given that we're looking at trillions more of printing in the next 18 months?
I think one thing, and James, I'll let James do the long version, but I'll do the short version, that I think people need to pay attention to this deal, this BRICS, there are 21 countries looking to get together to sort of de-dollarize their economies. And people should focus on it. It's China, Russia, Brazil, Iran, South Africa, a lot of deep, heavy commodity companies. And they're looking to conduct business with all of those other countries in currency other than dollars, which has been the way most commodities around the world have been engaged since 1971, when the U.S. government went off the gold standard. So there's definitely activity going on there. But James, why don't you do the longer version?
Yeah, look, if you believe in that this cannot go on forever, which history would suggest it cannot, I'd say the last 20 years in particular has seen the hyper financialization of business and of the US economy. So I think you want to look outside of the hyper financialized world, which increasingly is hard assets. And, we've touched on kind of all of those. And I think you pick which one, fits most closely with kind of your predilections. But I think that they're all going to work in different degrees, maybe a basket of them all, maybe a basket of companies that benefit from them.
Okay, guys.
Just one point, and that
Go
is
ahead,
that there have been 53 times in history when countries went above 100% debt to GDP, and 51 of those times their currency has failed. There's still an experiment going on in Japan, and now the US is there too.
Right.
So we actually were at 53 countries now over over the past, what was it, James, over the past 200 years?
I don't remember the exact number.
Something like the last 200 years, Gary. I can't remember the exact stat, but it's something like over the last 200 years, there have been 53 or 52 countries that had more than 100% debt to GDP, and the US is above that now.
Yeah, and to add to that, throughout history, there have been somewhere in the neighborhood of 775 fiat currencies. They have all gone to zero. It always ends the same way. So there's that. We're right up at the end of the hour that we had. I'm going to give myself the last word on this. Chris made a fantastic point about a potential BRICS competitor to the dollar as the world's reserve currency. I have spent the last week writing the longest, most detailed monthly letter I've ever written. And just yesterday, I was writing a lengthy section on this potential BRICS competitor and noting that people are dismissing it far too quickly. And everybody's pointing out the problems. There are problems, right? I'm not telling you that tomorrow Russia and China are going to say, hey, here's your new currency, and everybody's going to adopt it. But we will be seeing a long, slow decline of the dollar. More than half the world's population is looking to get off of the dollar standard right now. And they want something that's commodity backed, and this is designed to address it. And, one of the things we have internal debates here at Deep Knowledge Investing on this. Somebody who I respect and has a different opinion is Mish Shedlock, who runs Mish Talk. He's a new member of the Deep Knowledge Investing Board of Advisors. And he thinks, the BRICS potential competitor isn't a real thing. So maybe what we'll do is I'll see if I can get him for the next monthly meeting, and we can debate it all out amongst us. But right now I'm with you, Chris. I don't think it's going to be something that happens tomorrow, but I do think people are dismissing it too quickly. It's something worth watching. So here we are, the end of the hour. We hope this has been a helpful update on the markets, the economy, some specific investing ideas for all of you. Want to thank Chris Bell, National Sales Manager for Horizon Kinetics and a valued, happy member of the Deep Knowledge Investing Board of Advisors. Thanks for joining us. And James Starr, Portfolio Manager for the Horizon Kinetics Inflation Beneficiaries Fund. For those of you who are curious, he won't say it, but I will. The ticker is INFL. Chris, James, thank you so much for joining us. Really appreciate it. And for our DKI subscribers who submitted questions, thank you so much for participating, for sending in questions, for telling me what mattered to you. For anyone listening to this, do me a favor, send me an email or put something in the comments. Let me know about this, what you liked, what you didn't like, and what topics you want to see covered next month. I read everything that you send in, and we'll be happy to respond to that. Chris, thank you. James, thank you.
Thanks, everybody.